The way that I start looking at kind of the base premium, again, is the PUAs, right? We did a podcast on this, but this is really what drives the cash value early on. And again, we don't give enough respect to that base premium. When I'm looking at that base premium, the base premium, in my opinion, addresses four perils of life. The four perils being death, disability, long-term care, and retirement. If you talk to somebody long enough and you ask them what their concerns are financially, either it's one of those, typically it's going to be all of those at some point in their life. And that's really what that base premium is there to address. So when you look at that base premium, right, we've already talked about that's really what goes in to support that strong death benefit and provides that insurance coverage. So number one, obviously, if we're addressing the death as one of the perils, is we have that death benefit there. So when somebody passes, everybody is aware of that. And that's usually about as far as it goes in our understanding of what's available to somebody. But man, if you've got a whole life contract, you need to read it because there are living benefits in there. And there's one benefit in there that's called the accelerated death benefit rider. And what that does is that actually gives somebody access to their death benefit prior to their passing. So typically, once somebody's diagnosed with a terminal illness, they can access up to 50% of the death benefit, the net death benefit at risk in any certain year. And what I mean by that is if you have $1 million of death benefit, you have $500,000 of cash value, right? The net difference between those is 500. So that means somebody could access up to $250,000 of their death benefit in advance of their passing to use as a lump sum with no need for reimbursement, right? That is just to address quality of life. Huge benefit to most people because we don't have those long-term care policies in place anymore, typically. So death, right, is being addressed by that base premium. The other one that comes to my mind is disability. We've done a podcast on some of the riders that are available for a whole life policy, but there's two of them that are typically on there. They fall into the same category, but they are waiver premium riders. They're usually enhanced and then just a regular old waiver of disability. But what they do is they actually cover premiums if you are diagnosed as disabled. So that disability does have different qualifying factors based upon the extent of what they're going to cover. But man, just having the option or the ability to add that rider onto a policy where if you become disabled, the insurance company does come in and pay those premiums for an extended period of time, depending on, again, how long you're disabled. So those are something that you need to read, need to make sure you understand whether you put it on the policy or not. You do want to read that paperwork prior, make sure you make an informed decision. Ask myself, ask Anthony before issuing a policy. We're happy to give you kind of our 2 cents. The other thing I'd say on disability is typically those only pay out up to age 65 and then they shut off. So there's some things that you do want to make sure you understand in there. The third peril of life that I'm going to address with you guys is going to be long-term care, right? I touched on this is the long-term care market has completely dried up over the last 20 years. There's very few standalone long-term care policies that are out there anymore. And if somebody has one, they absolutely hate it, right? The cost of insurance has gone up. The premiums have gone up. And then also their benefits have decreased, right? So it was very difficult when long-term care policies went out into the market. They just didn't price it right. So there's not very many of them out there. But if you read your whole life contract, there is a living benefit on there that's called a long-term care rider. Not a long-term care rider, but it's a very similar. It's called a chronic illness rider. And again, what that does is that gives you access up to 25% of your death benefit, your net death benefit at risk, or up to $240,000. So same thing, if someone's diagnosed with a chronic illness, that means something that's going to take place for 90 days or longer, then you can submit an application to the insurance company and you can access up to 25% or $240,000 of the death benefit. Awesome, right? So you can do that as far as a lump sum, or you can get monthly or annual distributions that come along with that. So again, that's one of the riders that not a lot of people are aware of. And I don't know when they did this, Anthony, you might, but I remember when we first started, these living benefits, I don't think they were required on the policies.
No, they didn't come in till a few years later.
Yeah.
So it's fairly recent.
Yeah, it's like 10 years ago, I think, is when they started kind of mandatory putting these on there. And so you started reading these. So not a lot of people, if you've had a policy for a while, you may not have it.
Mhm.
If you want to want an old policy out, look at it, or if you want us to take a look at it, feel free, reach out, send it in to us. We'll read it, make sure you understand what you got. All right. So that was kind of the third peril. The last peril that I would say that the base premium addresses is going to be retirement. Anthony touched on this, but that base premium is really, really important. It's really just those first couple of years where it doesn't show up as cash value, but it's increasing that death benefit. After that third or fourth year, man, a majority of everything that you're putting in that base premium is showing up as cash, right?
Mhm.
That's forced savings. You can leave it there and just let it accrue over time. That's like the worst thing that you could do with it. Or you can take those dollars, leverage it, and go buy some assets with it, which is only going to increase kind of your net worth, your cash flow, and everything else. So that, in addition, is also preparing you for retirement. But that base premium, again, is going in there. It's increasing your death benefit, which increases your dividends, which increases your cash value. The other point I would make on retirement is having that death benefit in place. I think we did a podcast on this, but it's kind of somebody's permission to spend.
I don't know if we did. Maybe we should.
If not, man, we need to, right? Because we talk about this a lot. And Anthony, you touched on it, is when you're meeting with somebody, is our intention typically when we start working with somebody is always focused on cash value.
Mhm.
But as somebody starts to approach retirement age and we start looking at distributions and stuff, is, man, having that death benefit there allows somebody to spend down their other assets, right? Whether it's a taxable account, tax deferred account, something like that. And we can actually accelerate that spending down on those types of accounts because we have that death benefit there. We're not worried about running out of money. So that death benefit is valuable, and it becomes more valuable as you start to look at it and the way this whole thing works. So hope that worked for you guys. Hope that gave you a little insight. But man, 4 perils of life, that base premium addresses them all.
You want to see the entire episode? Click here. If you want to learn how investors use infinite banking to increase their returns and lower their taxes, click here. If you want to see if infinite banking is for you and you have some questions, hop on a discovery call with us and one of our coaches. The link for that will be in the description.